The cost of debt capital, debt rating approach. There are two things that determine the cost of debt capital: the general level of interest rates in the economy and the risk of the firm that has issued the debt. The general level of interest rates will be constant for all firms in the same economy at the same time, and therefore it's only the difference in the degree of risk that determines the difference between the cost of debt capital for different firms. So how can we measure the cost of debt? The first method is the yield to maturity approach. The second one, which we'll talk about here, is the debt rating approach. The yield to maturity approach can only be used if the firm's debt securities are traded in a liquid market, so that we can determine the fair price of the securities and from there calculate the yield which is determining that price. Often a firm's debt securities are not traded in a liquid market, and therefore an alternative approach is the debt rating approach. This involves comparing the firm with other firms of a similar risk, and assuming that if they have the same level of risk, their cost of capital should be the same. To use this approach, we need debt ratings. These are issued by companies such as Moody's, Standard & Poor's, and Fitch. This is an example of the ratings that they issue. There are a large number of different debt ratings, but I've grouped them here into three categories. The ones from AAA to, in the case of Standard & Poor's and Fitch, BBB- are called investment grade. They're reasonably safe investments. The next category are officially called speculative grade, but many people refer to them as junk bonds. This doesn't mean that they're worthless, it just means that there is a high probability of default, of not getting your money, but if you do, there will be a very large expected return. The last category, C in the case of Moody's and D for Standard & Poor's and Fitch, are reserved for firms that are actually in default, have not complied with the obligations of debt. Analysts will then take those debt ratings and determine the cost of debt for companies with each of those ratings. For example, an analyst might determine that firms with a AAA rating have a cost of debt on average of 3%, AA 3.2%, A 3.4%, and so on. There is one problem with this approach. The cost of debt of 3% implies a certain risk premium over and above the risk-free rate. Suppose the risk-free rate is 2.5% when these costs of debt are issued. If it then changes, for example, if it falls to 2%, all of these costs of debt would have to be adjusted accordingly. To avoid this problem, instead of issuing outright interest rates, as we saw a moment ago, they issue credit spreads, which is the risk premium over and above the risk-free rate of return that is implied by a firm's cost of debt. There is one further problem. Because these credit spreads are expressed as percentages, they could be confused with outright costs of debt. So instead, analysts usually issue credit spreads in terms of basis points, where a basis point is 1/100th of a percent. Standard & Poor's have given ABC Limited a debt rating of BBB. The risk-free rate of return is 3.25%. Shown here is an estimate of credit spreads from an analyst. What is ABC's cost of debt? We take the risk-free rate of return, 3.25%, and add 110 basis points, or 1.1%, giving us a cost of debt of 4.35%. There's one final issue we need to deal with. Because interest payments are tax deductible, the effective or after-tax cost of debt is not the same as the investor's required rate of return. The Australian Taxation Office allows firms to reduce their taxable income by the cost of debt, or interest payments that have been made. This is the formula to calculate the after-tax cost of debt, where RD is the before-tax cost of debt and TC is the corporate tax rate. For example, if the tax rate was 25%, the after-tax cost of debt would be 75% of the before-tax cost of debt. Based on its debt rating, XYZ Limited has a before-tax cost of debt of 4.25%. The corporate tax rate is 30%. What is the firm's after-tax cost of debt? We take the before-tax cost of debt and multiply by 1 minus the tax rate, which is 30% or 0.3, giving us an after-tax cost of debt of 2.975%.